Hi, Assalamualaikum. My name is Nur Alia binti Zamri. Today, my friends and I will present regarding the case study of Aroma accounting scandal. First, I will briefly explain about Aroma PLC. Jimmy Lowe started Aroma PLC in 1917 as a set of market stalls, and the first Aroma store debuted in the United Kingdom in 1927. Aroma's retail outlets were located in 10 different countries throughout Europe and Asia. In order to establish market position, Aroma pursued the strategy of being a geographical and low-cost provider. Aroma is a global grocery and merchandise shop based in the United Kingdom that is aggressively extending its retail location to every corner of the globe. The company progressed smoothly until September 2015 when Aroma acknowledged to manipulating £277 million in profit through aggressive accounting in profit recognition. This accounting fraud revealed when the corporation appointed a new CEO, Derek, based on information obtained from an internal whistleblower. The auditors discovered a profit misstatement of £288 million after additional examination and uncovered the previous year's manipulation of commercial income, which is a subjective area of accounting in a retail industry. Aroma's board of directors, according to Derek, had failed in their duty to oversee Aroma's business activities. To help us to identify in order to make sure that Aroma did not lose their competitive advantage, we use SWOT analysis. This SWOT analysis is the tool to identify strengths and weaknesses as well as opportunities and threats. The strengths are Aroma still exists and survive in market, and they become the top 4 market leader of groceries in United Kingdom. They also had been in the retail field for more than 30 years. Aroma has 4 weaknesses, which are the poor corporate governance in the company, misuse role of the regulators and stakeholders in curbing the accounting scandal problem, bad relationship between retailer and supplier, and uses aggressive accounting for commercial income in the retail industry. Then, for the opportunities, Aroma broadens product range to target new segment and attract new customer through special offer. Lastly, for the threats, competitors for Aroma are the Britain's big 4 supermarket, which are Asda, Sainsbury, and Morrison. Aroma also may lose of his supplier due to late payments. Aroma may face bankruptcy due to non-efficient strategies in marketing.
Assalamualaikum, my name is Nada binti Shaini and I'm going to present about the first issue in Aroma PLC that had led to this accounting scandal in Aroma. The first issue is because of the poor corporate governance in Aroma. This issue is also one of the factors that caused the share price in Aroma to drop sharply around 11.7% to £207.5. As we all know, the company's market capitalization and its market value are usually affected by the increase and decrease of their share prices. So the higher the company's stock price is, the more the company's worth in market value and vice versa. So the poor corporate governance in Aroma can be seen in the fact that just 2 of the company's 12 board members that only had vast experience in the retail industry. Due to the lack of retail industry professionals and the board of directors' lack of expertise, Aroma's Christmas sales were decreasing and had an unexpectedly low projected profit in 2015. So this shows that Aroma needs to understand the importance of having an excellent corporate governance. This can be accomplished by setting the right tone for the top management as well as developing a good organization culture. So setting the appropriate tone for top management is quite critical since it establishes the company's values and cultures. Employees are more prone to imitate the top management's behavior. Hence, the top management must set a positive example by clearly communicating and always promoting ethics and values to their employees. Failure to do so will result in engaging in fraudulent activities. Moreover, setting the right tone will give the board members the techniques to communicate effectively with each other, executives as well as the stakeholders. This is to ensure that all viewpoints are heard and also considered. Hence, this shows that it is important for a company to choose who is the right board members that is compatible with the top management. Second issue in Aroma PLC is the role of board and regulators in dealing with the accounting scandal. This can be observed when the board members fail to oversee their role in governing the company and had caused the accounting scandal to happen. So this is because the board members did not review and approve Aroma's financial statement when the accountant in Aroma, who is Augustine, claims that the company's profit is overstated by £277 million. According to Augustine, in July 2015, she tried to alert Robert, who is the finance director of Aroma, on this accounting error, but she failed to get his attention. Meanwhile, one of the Aroma's board of directors, Nicholas, the company's CFO, resigned in April 2015. However, he had made a mutual agreement with Aroma that he would still remain with the company with the unusual title, which is CFO Emeritus, until Aroma find a suitable replacement for him. The board members choose to disregard this matter and allowed the CFO position to remain empty for up to 6 months, posing a risk to the company's operations. To solve this issue, the board members should have reviewed and approved Aroma's financial statements and reporting when the accountant presented the company's financial statement to them. As a result, they would have noticed the overstated profit in the company's financial statement and taken appropriate action as soon as possible. This is to safeguard the company's asset while also taking reasonable steps to prevent and also to detect any fraud. The board of members should also in charge of overseeing the company's management in order to avoid the CFO position being empty for up to 6 months. They should have had someone prepared that is capable to take Nicholas's place as CFO as soon as he resigned. This is to lower the chance of the company's operations being disrupted. The third issue is the relationship between retailer and supplier. According to their terms, Aroma supplier normally supply the products first and then get payment from Aroma afterwards. Aroma, on the other hand, has always delayed payments since the downturn in sales in 2015, taking up to 3 years to make a single payment. Late payments can have a negative impact on a company's reputation. Building excellent working relationships with other parties is an effective method for achieving business growth. Furthermore, we must understand that our suppliers have their own liquidity concerns which we must respect. So to solve this issue, Aroma should make their payment on time in order to secure and maintain a good relationship with their suppliers. One method is to agree on invoice payment terms ahead of time so that they may manage their cash flow at the source and will be well prepared when the due date approaches. By doing so, suppliers' trust in Aroma as a business partner will grow, allowing them to negotiate better agreements in the future rather than creating a negative image of Aroma among suppliers. Last but not least, I want to discuss about the pressure that Aroma gets from the public, which causes them to manipulate their accounting books. The reason why they have £277 million overstated profit is because they delayed the record of their expenses, but they record their earnings earlier. They wanted the public to know that their company is still profitable. They also sought to keep their reputation and ranking in the sector in order to compete with their rivals. Aroma uses aggressive accounting method in order to retain its market reputation and share price. Alright, so Aroma can fix this by making excessive marketing strategy in order to attract the public's interest and boost sales rather than distorting their financial statements. So for example, Aroma may offer a discount on products that are about to expire or make special deals to attract new clients. Aroma is also under pressure as a result of having to compete with Britain's main 4 supermarkets. Aroma can address this by developing a new product that has yet to be introduced in the market and demonstrating how their firm differs from their competitions. So customers may be drawn to it, resulting in a spike in sales and a return of profit. That is all from me. I will pass the next presentation to the next presenter.
The next issue is accounting for commercial income. So, what is the meaning of commercial income? Commercial income is an income received when the company helps supplier to commercialize a product, to make a promotional, and to advertise a product. In this situation, Aroma receive this type of income when they help supplier to boost their sale, such as running a promotional offer. In return, Aroma will get discount and other 27 type of rebate after helping supplier to boost their sales performance. However, it is against the accounting policy to recognize this type of income as part of the sales revenue before arriving gross profit in the financial statement, since this income does not come directly from the main business activities of Aroma. In this situation, Aroma should disclose separately this type of commercial income from the sales revenue in the financial statement, which is it may recognize as other income in the financial statement. Furthermore, all the 27 type of rebate was charged a year in advance to the supplier. Then, Aroma will receive cash a year earlier for the payment made by the supplier before the actual sales were made. Aroma charged the payment to the supplier based on historical volume of sale. It will give effect to the financial statement since there is higher level of uncertainty in sales, because the sales not yet made but already recognized in financial statement. Financial statement should be relevant which reflect current situation of a business. Furthermore, it is very unethical of Aroma when they delay the recognition of an expense, which means that they do not record expense at the time it was incurred. For the solution, we truly suggest that Aroma will record their transaction based on accrual accounting, which means that Aroma should recognize revenue when it is earned and realizable. Realizable here means that Aroma should only recognize their revenue when their services have been received by the supplier. According to the accounting policy, Aroma should recognize their expenses when it is incurred or when the transaction is occurred, and not when it is paid. The issue that might be occur in the future is the relationship between Aroma and audit firm, which is KPMG. In this situation, KPMG has been engaged as an auditor of Aroma around 30 years, which is starting from 1987. According to Section 300 and 120 MIA bylaw, there is possibility of familiarity trap that might be occurred. Familiarity trap here means that the audit firm having long association with the client. This is because KPMG has been engaged as an auditor for Aroma for a longer period, which is nearly 30 years. There is higher probability for KPMG to sympathetic for Aroma bad financial position and may close their eyes for Aroma's wrongdoing. In order to solve this problem, as stated by MIA bylaw, audit partners should only serve same company with the maximum of 7 years. Even under Sarbanes-Oxley, it is compulsory to change auditor for every 5 years. This is to avoid any threat that might happen and to maintain positive reputation of audit firm. The next issue is inefficient marketing strategy. This might happen because we can see that Aroma more focused on aggressive expansion strategy, which is they open a new number of stores in order to compete with the competitors. However, they realized that opening a new store not an effective strategy to compete with the new competitors, since it is hard to maintain the profit margin, which resulting in continuous declining in the profit and their share price dropping from time to time. This happened because Aroma does not put their attention to the marketing strategy. It is still useless for Aroma even though they are hiring a new experienced director, such as Matthew, who is previously CEO of IKEA. If Aroma does not take this opportunity to expand their marketing strategy. In order to solve this problem, Aroma should hire a new director and employee that have skill and experience in marketing strategy, which able to bring back Aroma's reputation. Aroma should invest more in marketing strategy, such as Aroma should invest and advertise their store in social media. Currently, we already know that people easily attracted by posting in social media. Furthermore, Aroma should focus more on making annual promotion, a loyalty card in order to attract people to shopping at Aroma store.
Based on this case, the ethical issue that we have identified is maintaining one's integrity as an accountant. Augustine, an Aroma accountant, blew the whistle on the accounting scandal in July 2015, but it was ignored. Aroma's alarm bell went off when she delivered the report to the new CEO because she had failed to notify the finance director and the previous CEO about the accounting scandal. Despite the fact that she may lose her job, she is committed to blowing the whistle on the accounting scandal. Not all accountants can behave briefly like Augustine because most of them would accept bribes or go against accountant policy in order to avoid being fired. In a business relationship, the accountant performs as she does, which is straightforward and honest. As a result of this problem, all Aroma employees should look to Augustine as a role model for being honest and truthful in business relationships. They should emulate Augustine's bravery in rebutting the accounting issue as opposed to the other employees who continue to obey the company's judgment despite knowing that there was a mistake. Accounting's primary attribute that enables financial decision makers to make acceptable judgment is honesty. Integrity is an important factor of the accounting profession. Accountants must be honest, upfront, and forthright with their clients' financial information in order to maintain their integrity. Accountants should avoid utilizing sensitive information for personal gain or advantage. While there are errors or differences of opinion regarding the applicability of accounting laws, professional accountants should avoid the purposeful opportunity to deceive and manipulate financial data. So, we move on to the last issue in this case. In this scenario, the unethical issue is a duty as an auditor. In this situation, KPMG has been Aroma's auditor for nearly 30 years, beginning in 1987. However, in May 2015, KPMG expressed concern about Aroma's commercial income accounting due to the difficulties in understanding the uncertainty on how Aroma met the sales target and the timeliness of bookings where cash was received sooner than sales were made. However, the audit committee convinced KPMG not to disclose the recognition of commercial income because it is not an important area to publish in the audit report. Aroma attempted to enhance their income in an ineffective manner. Aroma accounting for commercial income is based on the concept of recording accrual profit earlier and deferring the recording of expenses. To address this issue, the audit committee should propose the Aroma disclose every single transaction in order to ensure that the information in the financial statement is an accurate depiction of the current company status, whether good or poor. Material information regarding the company's performance and activities should be made available in a timely and accurate manner. It is critical for the audit committee to reveal firm information in order to increase Aroma's efficiency and production. It is also significant since it can assist ensure that the board of directors has the information when they require it in order to make better decisions for the firm. That's all from us. Thank you.